Your trading style should be a reflection of your personality, and your stop loss strategy should be a reflection of your trading style. So let's talk about the stop loss strategies that we should use for various trading styles. Breakouts. When markets are either range bound or stuck in a retracement, then volatility will usually be very low. Consequently, when a breakout occurs, which will usually be in the direction of a prevailing trend, then this can serve as a unique opportunity to use tight stop loss orders. This will allow us to control a large position with a small amount of money. However, the type of breakout you encounter should determine your stop loss strategy. Let us consider this range-bound market that is on the verge of a bullish breakout. If the breakout occurs with a small amount of volume or volatility, then we say that the breakout is weak. This sort of breakout is probably the result of small retail traders. These traders tend to put their tight stop loss orders at obvious places, such as at the opposite end of a range. Therefore, on a weak breakout, you should place your stop loss beyond the opposite end of a range. Let us now talk about strong breakouts. A strong breakout can occur in one of two ways. Either in the form of one big candle, or in the form of 3 consecutive medium-sized candles. Under either set of circumstances, big money participants, i.e. commercial participants or leveraged hedge funds, are now in control of the market. Therefore, any stop loss orders below the first entry candle are now probably redundant. Ergo, you should place your stop loss near the relevant extreme of the first entry candle. Now, let's say our market of interest has an upwards/bullish bias, and it has been in a retracement for less than 21 business days. Let's say we have a pivot point within our retracement box. Please note, if you would like to learn more about pivot points, then please watch my video titled Trend Lines and Pivot Points. I will leave a link to the video down below. Rather than using the high or low of our retracement box, we could use the pivot point. This will, number 1, improve our market timing, and number 2, increase the size of our trade. Trend continuations. Let's say a market is trending in your favor and you want to add a trade to your overall position. Let A equal the 20 period ATR or average true range. A typical candlestick would look something like this whereby the size of the candlestick head equals 0.25 times A. The size of the candlestick body equals 0.5 times A. And the size of the candlestick tail equals 0.25 times A. Let's use the fact that market volatility is proportional to the square root of time. Let n equal the number of candlesticks that will serve as our grace period, i.e., during this time, we will allow our trade to be a losing trade. But afterwards, if the trade is still losing money, then we will just close it. On the daily chart, we normally set n to equal 4 or 5. If we were to define DSL to equal our stop loss distance, then we would have the following. DSL equals 0.75 times A times the square root of n. Market reversals. The easiest way to identify a market reversal is by using two simple moving averages on your price chart. Please see my video titled Price Action and Technical Analysis for Absolute Beginners. I will leave a link to the video down below. The required time-stamped section is between 3 minutes and 46 seconds and 5 minutes and 51 seconds. So, let's say that a market has entered a bearish retracement, but you are very bearish. You could instigate a sell order and place a stop loss at the shorter term simple moving average. If the market violates this stop loss, i.e. the market resumes its previous uptrend, then at least you know either your trade idea is wrong or your market timing is wrong. Day trading. Let's say we want to day trade a particular market. It would be useful for us to generate estimates for tomorrow's high and low. We can do this by using today's high, low, and close. Please note, our discussion will be based on page 119 to 121 of Larry Williams' book titled How I Made $1 Million Last Year Trading Commodities. I will leave down below an Amazon link to the book in question. In the book, the author refers to pivot prices. Please do not confuse this with pivot points. If you would like to learn more about pivot points, then please watch my video titled Trend Lines and Pivot Points. We will use a little bit of mathematics to calculate pivot prices and the most likely extremes for the next trading session. You should only use these calculations when market volatility is either low or steady. Let H equal today's high. Let L equals today's low. Let R equals today's range, which equals H minus L. Let C equals today's close. And let P equals today's pivot price. which equals H plus L plus C, all divided by 3. And net M up arrow equal the size of tomorrow's most likely up move, which equals P minus L. And net M small arrow equal the size of tomorrow's most likely down move, which equals H minus P. So we have the following. H hat 1, which equals tomorrow's most probable market high, which equals P plus M up arrow. H hat 2, which equals tomorrow's most probable market high if there is a slight increase in volatility, which equals P plus R. L hat 1, which equals tomorrow's most probable market low, which equals P minus M down arrow. And L hat 2, which equals tomorrow's most probable market low if there is a slight increase in volatility, which equals P minus R. If you have any questions, then please either send me an email or leave a comment down below. Thank you for your time and happy trading.